How's everyone doing? Welcome to the Strategy Room on this Friday night, January 30th, 2026. I hope everyone has had a great week out there. Settle in because we got a lot to go over tonight. So, we got a new Fed chair just picked this morning by President Donald Trump, Kevin Warsh. We're going to talk a little bit about Kevin tonight. We're also going to talk about the Federal Reserve's decision not to increase interest rates. And that happened just a couple of days ago. Jeremy Powell had some interesting comments there on that one, and President Trump had his usual reaction, as you could imagine. Outside of that, I have a lot of other banking news to bring everybody. I got some economic indicators to talk about. We got some ACH with Nacha stuff to talk about tonight. What else we got going down? A whole lot of banking news. I wanted to give everybody a little bit of a real estate update on, just a couple articles on the real estate market. We're going to talk a little bit about SBA tonight. I wanted to give everybody a little update on what was going on in the private credit market, just kind of a little update on First Brands and some other things like what's going on with some of these bankruptcy cases and things like that. So obviously a lot of stuff to cover here tonight. So we are going to get rocking and rolling here, as I always do. We are going to start off with the U.S. debt clock. So we are still cruising at $38.6 trillion in the national debt. U.S. federal budget deficit is still at $1.7 trillion. U.S. federal spending is still a little over $7 trillion. The tariff revenue is now up to $372 billion, and that equates to $3,247 per taxpayer. The debt to GDP ratio is still at 124.31, so still a lot higher than what we would like it to be. You can kind of see there over the years, like 1960, it was at 53%. In 1980, it had dropped down to 34.5 or 34.5%. 2000, even as recent as 2000, it was still only 59.35%. So you could see how even in the last 25 years, the spending has just gotten completely out of control. Our defense spending still at $928 billion. The interest on our national debt coming in just under $1 trillion at $987 billion. Credit card debt still at $1.3 billion, and that comes out to per household at $8,177 per household. So that's where we're sitting at tonight. I always like to go over this at the beginning because usually as we go through the night, I hit on a couple articles that basically necessitate us to kind of come back to this to take a look at, to point out a few of these things. So let's take a look at interest rates here. Obviously, I would say the last 3 days, stock market's been down. We got the Fed interest rate decision, which was no decision. They were just going to stand pat. And what has that really done to rates here? Well, the 10-year T-note still hovering in at 4.238. Not much of a change from last week. I would say up just a tad. It had shot up to about 4.28% here earlier today, but then came back down. So again, not really too much of a change from last week. 30-year bond is still at 4.875. The 2-year T-note is still at 3.539. So again, rates up a little bit. And I know mortgage rates, we'll talk about that a little bit later, how mortgage rates kind of spike back up a little bit this week, causing mortgage volume to go down. So we'll talk about that a little later as we get into the evening. But this, obviously, the big news kind of the day here. So Senate passes a funding deal, but the government will still partially shut down at midnight. So the Senate passed a deal to fund federal agencies and give lawmakers more time to work out disputes over the Department of Homeland Security. The deal's passage will not prevent at least a brief partial government shutdown from taking place over the weekend. House Speaker Mike Johnson reportedly said he will back the Senate-passed funding deal in light of President Trump's support for it. So again, here, it's kind of like, here we go again, right? Another government shutdown, right? So this does not appear to be anywhere near as bad as what we just experienced the first few months ago, but still something to keep an eye on. Now, they'll be working on this over the weekend, but I think that the House is on a recess now. Is the House ever not on recess? I mean, really, do these guys ever work? It's like, so I don't know if, again, I think that's why they're saying that this will be a partial fund day, shutdown over the weekend, because the majority of House members will not be back until Monday. And so therefore they won't have their vote until Monday. But again, it looks like this will be, if we do have some kind of government shutdown here, this will be short lived. They'll get back in there on Monday, they'll pass it, and then hopefully, that will be the end of it. We certainly do not want to see any kind of another prolonged government shutdown like we just had a few months ago. So, so like I said, just wanted to bring that to everybody's attention to let everybody know what was happening with that. So now the big news of the day, the big news of the week. President Donald Trump nominates Kevin Warsh for the Federal Reserve Chair to succeed Jeremy Powell. So President Donald Trump on Friday named Kevin Warsh to succeed Jeremy Powell as Federal Reserve Chair, ending a prolonged odyssey. Love that. That's great. Odyssey. That has seen unprecedented turmoil around the central bank. I have known Kevin for a long period of time and have no doubt that he will go down as one of the great Fed chairmen, maybe the best, said Trump in a Truth Social post announcing the selection. So, so now we have Kevin Warsh. Now, and I'm going to talk about this for a little bit, but this is it's a very interesting selection. I will be the first to say that Kevin was not my first choice. He might have even been my last choice. I liked Kevin Hassett a lot more, just because of a lot of the things that Kevin Hassett has said over the preceding months. Rick Reeder made a surprising kind of like, he was like the dark horse, but he made it almost like a surprising move to the inside. And I thought he was going to finish across the finish line, but he didn't get there. I have a high amount of concern with Kevin Warsh being the pick. And I'll say this for a couple. I'm going to tell everybody a little bit about Kevin's background. I'm going to tell you why I'm concerned, and I'm also going to tell you why I think Trump ultimately made this pick. So let's start with Kevin's background. I do have so everything you need to know about Kevin Warsh. So let's see if we go in here. So in his first stint at the Federal Reserve, Kevin Warsh came to a central bank that was about to be asked to save the world. He returns now under very different circumstances, asked to serve a notoriously fickle president who will place significant but very different demands on him. Warsh indeed is a Fed veteran, serving during the critical period of 2006 to 2011 that led up to and ultimately through the global financial crisis and the central bank's efforts to stabilize the economy. Appointed by President George W. Bush, Warsh was one of the youngest members ever to serve on the Board of Governors. I believe he was actually the youngest at 35 years old. While at the Fed, Warsh played an important role in the design and implementation of emergency lending programs aimed at stabilizing credit markets. Warsh also played a key role in helping devise the MyRaid programs aimed at rescuing the economy. One of those programs, developed separately at the Treasury Department, became known as the Troubled Asset Relief Program, developed by Neil Kashkari, who is now the Minneapolis Fed president. However, Warsh emerged from the area as a Fed critic. He warned that large-scale asset purchases and near-zero benchmark interest rates ran the risk of distorting markets and undermining long-term price stability. While supporting the earlier efforts, keep that in mind for a minute, while supporting the earlier efforts, Warsh voted against the second round of Fed bond buying, a program known as quantitative easing. So now, again, President Trump made the comment this morning that he had typed Kevin out of central casting. Now, Warsh was further criticized, the post-financial crisis Fed, with going too far in monetary policy stimulus, contending that it is helping sow the seeds for further crisis. In some respects, President Donald Trump is appointing a Fed chair who may be even less inclined to accommodate political pressure than Jeremy Powell. Yes, that's my concern. Trump cited Warsh's extensive background in announcing his appointment to the top Fed post Friday morning. Warsh is currently a distinguished visiting fellow at Stanford University. On top of everything else, he is central casting, and he will never let you down. We'll see. Warsh is a Stanford University graduate who earned his law degree from Harvard and ultimately married into the Lauder Cosmetics family. Before joining the Fed, he worked in investment banking at Morgan Stanley and served in the George W. Bush White House as a special assistant to the president for economic policy. While positioning himself as a defender of Fed independence, Warsh also has criticized it for mission creep and told CNBC in an interview last year that the central bank needs regime change. Warsh made his misgivings known about the current Fed. The credibility deficit lies with the incumbents that are at the Fed, in my view, he said during that July interview. It's a position that could put him in an adversarial role at an institution where consensus building is key to policy implementation. Despite multiple missteps on policymaking, Chair Powell has largely been able to keep the Fed consensus together. However, in recent months, that has faltered. Yes, of course it has. Warsh's appointment would mark a sharp philosophical shift from Powell's pragmatic, consensus-driven approach and signal a potential tightening of the Fed's tolerance for inflation and balance sheet expansion. He would fit the seat currently occupied by Stephen Miran, whose term expires on Saturday. Miran told CNBC on Friday that he supports the pick. Chairman designate Warsh as a long history of being an innovative and original thinker on monetary policy. Miran said he's got a number of really important insights over the years, and I'm really excited to see all the good work he's going to do at the Fed. So, couple things I want to point out here about Mr. Marsh. Mr. Marsh has an undergraduate degree in political science. He did get some kind of minor or something in economics as part of that, but his main degree was in political science. He then went to Harvard and got a law degree. He then got some kind of economical background or some kind of economics training in some kind of dual program that I think he did between Harvard and MIT or something along those lines. So why do I point this out and why do I think his background is so important? Well, Kevin Warsh is not a classical, economist. He's not a classically trained economist. He didn't go to school for economics per se. And he has a background very, very similar to Jeremy Powell's. One of my biggest criticisms of Jeremy Powell is that Jeremy Powell is not an economist. Jeremy Powell is a lawyer. He's a private equity attorney, and he's a political animal. Kevin Warsh is also, wait for it, an attorney and a merger. Most recently, Kevin was working at Morgan Stanley doing what? Mergers and acquisitions. So Kevin, too, is a lawyer, Wall Street guy, political animal. He was a Bush appointee, worked in the Bush White House before he went over here. So Kevin Warsh, while he might have been very critical of the Fed, he had no problem playing ball while he was there before. And he, again, it would be one thing, I've covered the Lords of Easy Money. And I think that time period, again, Thomas Honig, the star character of the Lords of Easy Money, he was the contrarian. He was the true dissenting vote back then in 2009, 2010, 2011. That was all Dr. Thomas Honig back then. He was the dissenting vote. Kevin was not the dissenting vote. Kevin was the one who was like, oh yeah, let's come up with all these stimulus programs. Let's do quantitative easing. I'll go right along with Ben Bernanke. I'll vote for all this stuff. That was Kevin. And then, of course, after he left, then it's like, oh, okay, now I'm going to play Monday morning quarterback and basically say, oh yeah, they took it too far. They went too far, this, that, and the other thing. He's not wrong, but what I'm saying here is that, he's sitting there on the one hand saying that, like, oh, we need regime change, we need this, we need that. I'm highly concerned, and they said it right here in this article that, and I forget where they said it in here, but it's basically like, this guy could be even more resistant than Jeremy Powell, and I would not be shocked. And I'm telling, I'm praying that Trump does not come to rue the day that he put this gentleman in there, because I could very easily see this guy getting in there and going, no, we're not gonna decrease interest rates. We're just gonna keep it. We're gonna go right along the line that Jeremy Powell is. He falls right in. He's gonna be like, I gotta finish working on our Taj Mahal building over here, get that done, and we'll just keep an eye on things, but we're just gonna keep things very status quo, not really shake it up too much like that. That is my big fear here. And one of the things you have to look at is, who is excited about this pick? Is Wall Street excited about this pick? Well, he's a Wall Street guy. Yeah, they like, Wall Street very much likes Kevin Warsh. Is the Senate very excited about this pick? Are politicians on Capitol Hill excited about this pick? Yes, he's an establishment guy. He's a Bush guy. They like him very much. Is the Fed excited about this pick? Yeah, I don't think they're probably not too worried about Kevin coming in there. He's certainly a better looking pick than Rick Reeder or Kevin Hassett was. So I have a lot of concerns here about this, about Kevin's background, because I feel like his background lines up very much with Jeremy Powell. And one of the things I said about Powell is that if you don't want, again, the Fed's always screaming about their independence, right? Oh, we need to be independent. We need to be independent. Well, here's a thought. Why don't you stop putting people who are political animals in as the head, who are then making very political decisions, or cutting interest rates in the middle of an election year to help a certain side? Why don't you stop putting people in there like that? Now, Kevin may not do that. He may not. I'm going to try to give him the benefit of the doubt. He may not do that at the end of the day. However, I'm just saying that his background looks an awful lot like Jeremy Powell's background. When you see the establishment high-fiving because that's their boy, okay, that wasn't the pick that we wanted. Okay, that was not the pick that we wanted. That's just the reality. Now, let's get back to the real question at hand. Why then did Trump go with this pick? Well, I think it really comes down to the Senate, and he has to go through a confirmation process. He has to go through confirmation hearings. He has to get approved by the Senate. I think a lot of the advice that the president was getting was probably something along the lines of, listen, you can pick Rick Reeder, you can pick Kevin Hassett. They're not going to get through the Senate. They're not going to get through the Senate. They're not going to get picked. And as a matter of fact, I have an article right here. Let's see here. Let's go to this for a second. Senator Tom Tillis will oppose President Trump's the Fed chair pick Warsh until the Powell probe is resolved. Now, I'm no fan of Tom Tillis. I don't think many people in this country are a fan of Tom Tillis. I think Tom Tillis needs to go retire already. But this is the kind of thing that I'm talking about here. And I think, look, if Tom Tillis wants to hold up his pick, okay, so be it. Who cares? Okay, that's not enough of a swing, and there's not enough people on the Senate that agree with Tom Tillis that they're going to hold up Kevin Warsh's pick. So if he gets one person that votes against it, it don't matter. It's not going to make any difference at the end of the day. But if he would have put up a Rick Reeder, who, even though he's a Wall Street guy, he's a BlackRock guy, he's still kind of an outsider from a Fed perspective. If he picked Kevin Hassett, Kevin Hassett had made a lot of noise about wanting to go in and just really shake things up at the Fed. And the Fed did not want that. They were not happy about that. And so I think, unfortunately, both of those guys would have faced very, very difficult Senate confirmation hearings. And it might have even got to the point where Trump might have had to pull them back and basically say, all right, I'm going to pull them back and I'm going to have to nominate somebody else. So I think in this position, Kevin Warsh, in that respect, was the very safe pick. He was the guy. He was probably the one guy of the four he was looking at that he could easily put up there and would basically sail through the Senate confirmation hearings. Now he'll get up there. You'll get a lot of what I call the kabuki theater. Like, you'll get up there. The Democrats will give him a hard time. Tom Tillis will probably give him a hard time a little bit, but ultimately it's all for show, because he'll go through, he'll get nominated, he'll go in. So I don't really have much issue with that, and I truly believe that is ultimately why Trump went with him as his pick at the end of the day. Because he ultimately will sail through the Senate confirmation hearings and he'll get picked. The real question now becomes is, what will Kevin really do when he gets there? Will he really make some changes? Will he really try to shake things up a little bit? Will he really try to focus the Fed on some other things and bring down interest rates in doing so? Again, I hope so. But I have a lot of doubts. I have a lot of doubts about this pick. This guy would not have been. He would not, like I said, he was not my first pick. And to be fair, I was not really in love with the final four picks that had come out. I wasn't really in love with any of them, because I thought that they all had I thought that they all had their flaws. And Kevin Hassett was the front runner for a good portion of the last 3-4 months. But I was very iffy on Kevin Hassett because he just didn't, he didn't. I felt that the type of person that the Fed needed was somebody who was really going to go in there and was going to, really kind of kick some people in the butt and really shake things up and really get things going, break up some of that groupthink that was going on there. And Kevin Hassett seems like a really nice guy and all that, but he just doesn't strike me as the type of guy who's going to go in there like Roddy Piper and say, yeah, I'm here to, kick what and chew bubblegum, and I'm all out of bubblegum. So I just don't get that impression about Kevin Hassett. Rick Reeder, really interesting choice there. But like I said, I think Rick would have had a very difficult time getting through the Senate confirmation process. So Kevin's our guy. And we will see what happens here with Mr. Hassett. Again, we got this Tom Tillis over here, but like I said, I don't think that's really any big deal in there. So that's our pick. We talked about that. Now, here's an interesting thing. So this was kind of a side effect, if you will, of this pick today. So silver plunges 30% in the worst day since 1980. Gold tumbles as the Warsh pick eases the Fed independence fear. So again, what does that tell you? Wall Street's telling you they love the pick. The Fed is telling you that they like the pick. Okay. And this is how the market reacted here. So silver futures plummeted 31% to settle down at $78.53, marking its worst day since March of 1980. The sharp moves down were initially triggered by reports of Warsh's nomination. However, they gained steam in the afternoon U.S. trading as investors who piled into the metals raced to book profits. Metals were also under pressure as the dollar spiked higher. So again, you see the silver spot price here really coming down from that high of almost $110 that it had hit just earlier. I think probably on the day before on the 29th. So again, just very interesting reactions here from gold and silver, as a lot of people basically just said, yeah, okay, this is a viewed as a good pick again from the Wall Street crowd. And they liked it, and so that eased off the the buying here on gold and silver, at least for a day or so. So I wouldn't be surprised to see these see the shares here of gold and silver, shoot. But I should say the shares, not the shares, the price of gold and silver go back up here. But we'll see. We'll keep an eye on it. So okay, now let's spend a few minutes talking about the Federal Reserve's decisions, shall we? So. On Wednesday, the Federal Reserve basically decided to hold the key interest rate steady as the economic view improves. So the Federal Reserve held its key interest rate steady at a range between 3.5% and 3.75% after a recent run of interest rate cuts. Available indicators suggest that economic activity has been expanding at a solid pace. Job gains have remained low, and the unemployment rate has shown some signs of stabilization, the central bank said in its post-meeting statement. Inflation remains somewhat elevated. So again, the Federal Reserve holding the rates steady. So let's keep that up here. So I am going to read you guys a couple things, and you guys can kind of digest this little chart here. You know what? I'll make this a little bit bigger here so that everybody can kind of see what I'm looking at here. So this is the Fed funds rate. So you can see how came down here again to zero in 2000 during the pandemic, got held there until March of 2022. And then the Fed went on one of the most aggressive rate tightening increases. I think they had 13 total rate increases here into July of 2023. And then that held steady until July of 2024. Rates came down a little bit in 24, held steady for most of 25, and then toward the end of the year, we had another 75 basis point rate cuts. So, okay, so reading from the Fed statement here, the Fed press release, we'll go to We'll go to the Fed press release here for a second. So, available indicators suggest that economic activity has been expanding at a solid pace. Job gains have remained low, and the unemployment rate has shown some signs of stabilization. Inflation remains somewhat elevated. The committee seeks to achieve a maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate. In support of its goal, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So there's the statement. And then, so the market's reaction. So the markets are now pricing a lower probability of near-term cuts with some expectations for a cut around mid-year, though timing is uncertain. So now the market is basically saying that they're not having any kind of expectations for a rate cut. Now, why would that be? Why would it be that they wouldn't have an expectation till maybe around June? Well, there's a certain Fed governor sitting in the chair right now whose time is up in May. So Kevin Warsh, even though he was named by President Trump this morning, he would not get nominated or put into that seat until at least until June. So that's why they're saying that basically the market feels like that Jeremy Powell is going to sit here for the next 5 months and he is not going to do anything unless something dramatic happens. Unless the economy really starts to have some kind of and some kind of spike in inflation, or the unemployment rate really starts to go up. Labor market really starts to see some problems. In that instance, maybe they react, but outside of that, probably not. So forecasts suggest that inflation will stay above 2% and GDP and labor market conditions remain relatively stable. Now, keep in mind, the Federal Reserve's own projections showed inflation topping out around 2.9% at the end of last year, and then basically inflation was going to steadily come down through 26 and through 27 to around about the end of 27. Inflation was going to get down to their, just below like 1.8, 1.9%. So, so that is their own projection. So even though they say that, they think it's going to stay elevated, they do see it coming down as we go throughout the year. So the FOMC announced the following action. So now keep in mind here, it was a 10-2 policy vote. So once again, we did have some dissenting votes here. So Governors Waller and Mirren dissent in favor of a 25 basis point cut. The labor market has softened modestly, but remains stable. So, and the Fed signaled readiness to adjust policy as appropriate, but did not commit to specific cuts at upcoming meetings. So again, no shock there per se. But let's look at a couple of things here real quick. So what was Trump's reaction to all this? Well, Trump calls Fed's Powell a moron after central bank holds interest rates steady. So no shock there. So Trump calls Fed's Powell a moron after central bank holds interest rates steady. Trump blamed Powell for costing Americans hundreds of billions in unnecessary interest expense. So, once again, let's see here. What do you say? President Donald Trump slammed Federal Reserve Chair Jeremy Powell on Thursday after the central bank held interest rates steady. We should have a substantially lower rate now that even this moron admits inflation is no longer a problem or a threat, Trump wrote in a Truth Social post one day after the Fed's rate cut meeting. He is costing Americans hundreds of billions of dollars a year in totally unnecessary and uncalled for interest expense because of the vast amounts of money flowing into our country because of tariffs. We should be paying the lowest interest rate of any country in the world, Trump wrote, adding that Powell was harming U.S. national security. So again, the exchange of words here, no shock. I mean, I don't think anybody's surprised by this. But again, yeah, Trump is just he's gonna ride Jeremy Powell all the way out the door here. So now here are 5 key takeaways from the Fed rate decision. So number one, the decision, to no one's surprise, the rate-setting Federal Open Markets Committee held its benchmark funds rate in the range of 3.5 to 3.75%. The move broke a string of 3 straight cuts and could be a harbinger of a central bank not of a mind to ease again anytime soon. Number two, the dissents. As has been the custom for the past 6 months or so, multiple committee members broke ranks. This time, Governors Stephen Miron and Christopher Waller wanted another 0.25 percentage point cut. For Miron, though, it represented a bit of a turn as he deviated from 3 prior dissents in favor of half-point reductions. So number three, Powell's post-meeting news conference was, in a word, a snoozer. On 5 separate occasions, the chair delivered variations on "I have nothing for you on that," to questions from reporters looking to bait him into commenting on the multiple political kerfluffles. Love, that's a great word, kerfluffles, surrounding the Fed. Asked for the advice he would give his successor, Powell responded, "Stay out of elected politics." Yeah, maybe Powell should have taken his own advice. Number four, from an economic standpoint, the FOMC statement and Powell's commentary reflected expectations for solid growth, a near-term tariff-fueled boost for inflation that ultimately will recede, and a labor market in stasis as the labor force participation rate plus less immigration keep hiring in check while layoffs are also muted. And then number five, as the markets yawned with little to go on, the major stock averages closed little change. Traders are still pricing in about a 60% chance of 2 additional 0.25 percentage point rate cuts this year. So again, very interesting stuff there. Yeah, I mean, Jeremy Powell, yeah, he really doesn't have much to say these days. I mean, he knows his days are numbered. He's only got a few months left here, and then he is going to be out the door. Now, interestingly, Jeremy Powell actually has another, I think, like 2 years on his term just as a Fed governor. So I think there is a possibility that he could stop being chairman, but he could remain on the Fed board. Now, will he do that? I mean, I think there's always a chance or a possibility he might, but at the end of the day, I really don't think he'll do that. I mean, I think that would be highly, highly unprecedented, because I think it would be seen as, him basically stepping, with the new Fed chairman coming in. I think it would be seen as him, stepping on the toes of the new Fed chairman, which would be very much out of tradition at the Fed, and something that just, would not, I don't think that would sit well with a lot of the other governors there. So I think that come May, I think he will be, done his thing, and he will go on. So, all right, let's see here. What else do I have? So, again, here's some of the things that changed in the Fed statement. So some of the things that were axed out there. So, again, available indicators suggest that the economic activity is expanding. They took moderate and put solid in. Job gains have slowed this year and they crossed that out and put in remained low. And the unemployment rate they took out edged up through September. More recent indicators are consistent that inflation they changed it from has moved up since earlier in the year and just remains somewhat elevated. So again, that is very positive language there. So they went from economic activity from moderate to solid, job gains from slowing to remain low, unemployment rate from edged up to basically shown some signs of stabilization, and inflation from moving up to just remains somewhat elevated. So again, all good, I think, comment changes here. And, again, when you take a step back and you look at the economy, I mean, again, everything is going okay for the most part right now. I mean, GDP growth numbers look really, really strong. Trade deficit has been going pretty. We'll talk about that a little bit later. Trade deficit has looked pretty good. But the big issue remains that inflation is still staying stubbornly high. Like, in other words, hanging around at that 3% mark. That's really the big issue right now. Affordability. Obviously, the price of a lot of goods, continues to go up, especially in the food store, and the affordability of houses. Those remain kind of the two big issues. And if people remember, this time, for anybody again anybody who's been watching this live stream for the last year, if anybody kind of takes a step back, goes back to last year for a minute, what I said with Trump coming into office was that I had high hopes that he would do a lot of good things for the economy, which I think he has delivered on. But I also said I thought 2025 was going to be a very choppy year, because I thought that the task in front of him and the other people, the monumental task, was enormous. And I think it is amazing what Trump has accomplished. In spite, it would be one thing if everybody in the boat was rowing in the same direction, right? Well, the problem is a number of people have not been rowing in the same direction. Congress has done basically nothing. I mean, aside from passing the one big beautiful bill, they've done absolutely nothing. They managed to shut down the government. They've squabbled about a bunch of stuff. They haven't passed hardly any of the president's, next to nothing as far as the president's legislation and all the things that he wanted to get done. So this Congress has moved, slower than a snail, and that has been very disappointing. But that's not Trump's fault. That's Congress. And then the other thing has been the Fed. The Fed has just not, they've just not, Jeremy Powell, since the minute that Trump came back into office, has been, Captain Les Resistance. And, he's been like Eric Cartman. He's like, forget you guys. I'm going home. I'm taking my ball and I'm going home. So again, and again, you got to give kudos to Scott Bessent right now. I mean, Scott Bessent, that guy has done just an absolutely remarkable job as the Treasury Secretary. I mean, what he has been able to do, I mean, just navigate the Treasury and the Treasury auctions, the bond market, really keeping things stable, keeping rates where they are, really working with the president on a lot of these tariff deals. I mean, it's just been, Scott Bessent has just been incredible. I mean, you got to give that guy an triple A rating, A++, whatever you want to say. I think, Scott Bessent, if he continues doing what he has done for another 3 years here, he's going to go down as one of the greatest Treasury secretaries we've ever had. I mean, there's just no question about it. But let's go on here. Let's kind of, I have a couple more things here on our Fed discussion here. So Fed is likely to lower rates only 2 more times, even under Trump's next chair pick, CNBC, according to a CNBC Fed survey. So CNBC Fed survey respondents see just 2 more quarter-point cuts this year, with no reductions expected yet for 2027. Forecasters don't believe the next Fed chair installed by President Trump will drive down overnight rates toward the low levels demanded by the president. Improving GDP and labor market expectations are behind the firmer rate outlook. Survey respondents see Trump naming former Fed Governor Kevin Warsh to the chair position, which of course he did. So despite the expected arrival of a new Trump-appointed Federal Reserve chair in coming months, respondents to the CNBC survey are only forecasting modest changes to the fund's rate over the next 2 years. The results, which mirror pricing in the Fed funds futures market, show that neither Wall Street nor economic forecasters believe that the next Fed chair will drive down overnight rates toward the low levels demanded by the president. Now, here's what I'm going to say on that. So I have said, even going into last year, that I thought the sweet spot was to bring rates down 150 basis points and to basically bring the federal funds rate down to 3%. Right now it's at that 5.5 to 5 point, or it's at the 3.5 to 3.75 mark. I thought you bring it down another 75 basis points, you take it down to the 2.75 to 3% mark. And I thought that was the sweet spot, because you again, we don't want to do zero interest rate policy, the ZIRP, which the Fed did for well over 10 years. We don't want that. We do not want to go back to the zero interest rate policy. That was very, very harmful for the economy, and there's no reason to do that right now. That being said, though, and the other thought process too is that you wouldn't want to go back to zero, because if something bad does happen, then the cupboard is bare, as they say. Like, there's nowhere to go. Like, you're not going to go negative, because we already saw the negative experiment. In the 20 teens, we already saw that with Japan and with Europe. They went to negative rates, and it was a disaster. So you're not going to go negative on the interest rates. And like I said, you've got to leave yourself a little bit of room. So I thought if they took it down to the Fed funds rate, if they took that down to 3%, that would leave them still with some room to work if something, again, if the economy started to go sideways or something really catastrophic happened, that would leave them some room to work with. So I still believe that to be true. Like, I still believe that they should probably bring rates down another 75 basis points. So they are, like I said, I thought they should bring it down 150 basis points. They've gone halfway there. They did 75 basis points at the end of last year. I would just do, and I would message that. Again, one of the tools in the Fed toolbox is something called forward guidance, and I would have just come out and said, listen, we're going to continue the quarter point decreases. We're going to do 3 more. We're going to take this down to the Fed funds. We're going to take the Fed funds rate down to 3%. And then we're just going to leave it there for a while. We're going to give it some time and just see what happens. And I would say we are going to stagger. If you want to stagger those decreases, that's fine. You could do them like every other meeting. So say, like, when they come back in February, like, okay, we'll cut one in February. Maybe we'll cut another one in May. We'll do another one in July. So that way that the rates are staggered, you kind of move it out, but you set the tone and with everybody. You kind of keep Trump happy, because you're continuing to bring the rates down. But again, it comes back to this point of it's very concerning that Trump wants to see a dramatic decrease in interest rates. I mean, he probably wants them back down to 1%. And I don't, like they said, according to the survey, and like I said, my concern with Kevin Warsh is that he's not going to give you that. I think it's far more likely that Kevin Warsh goes along with this with the comments from this Fed survey here, where they're basically saying, like, yeah, we see 2 rate cuts this year, and then that's it. So so we'll see. Like I said, we'll see what happens. We'll keep an eye on that, and then okay, and then finally, this last thing here. So they've still not complied with the subpoena as the Jeremy Powell probe continues. So the Federal Reserve has not yet complied with the grand jury subpoenas issued as part of a criminal investigation of Fed Chair Jeremy Powell. A person familiar with the situation told CNBC. The probe of Powell is continuing, according to that person, who spoke hours before the Fed revealed its decision to hold interest rates steady. It is not clear when the deadline is for the Fed to turn over documents demanded by the subpoena. So, again, this is very interesting because, hey, they convened a grand jury. Now, again, I know the old adage, you could get a grand jury to indict a ham sandwich. Has always been the joke with that. But again, I mean, but the fact remains, he got the grand jury issued the subpoenas and basically said, yo, you've got to, we got some questions here and you need to provide answers to these questions. And the fact that they're just basically just totally ignoring it, I don't know, again, I don't know if this is just a tactic to kind of ride Jeremy out of town, and that after he leaves in May, this all just kind of goes away, or if this in fact is, more serious about this, and they really are going to go after him for basically saying that, hey, you lied in front of Congress, man, and you took all these funds and used it to build this Taj Mahal building, and I did a whole rant last week on the Fed's Taj Mahal building that they're building down there for $2.5 billion, which is just as much, if not more, than some of the nicer NFL stadiums that we've seen built in the country in the last few years. So again, this is getting really interesting, and we'll have to keep an eye on this to see what happens with this. So, all right. All right, that's enough with the Fed stuff. Now we're going to start to jump into some other things here. So, some issues around the US dollar this week. So, there's some stuff going on right now with the yen over in Japan that is basically causing some issues here in the bond market. But the U.S. dollar rebounds after Bessent shuts down report of potential yen intervention. So Treasury Secretary Scott Bessent shut down reports that the U.S. may step in to the currency market in an interview with CNBC. His comments come a day after President Donald Trump described recent weakness of the U.S. dollar as great. The U.S. dollar index fell to its lowest level since 2022 on Tuesday. Treasury Secretary Scott Bessent on Wednesday shut down reports that the U.S. could step into the currency market with the Japanese yen on intervention watch and the American dollar hitting multi-year lows. Absolutely not, Bessent told CNBC's Sarah Eisen, responding to a question about if the U.S. is intervening in the currency market or strengthening the yen. The U.S. dollar index, which tracks the American greenback against a basket of foreign peers, rose 0.4% on Wednesday following Bessent's comments. The index on Tuesday saw its biggest one-day slide since April and fell to its lowest level since 2022. So this is the ICE U.S. dollar index, basically down to 97. Reuters reported last week that the New York Federal Reserve had reviewed dollar to yen rates with dealers, citing a person familiar with the matter. Such a move is viewed as a precursor to intervention, Reuters reported. Bessent told CNBC on Tuesday he had no comment on the report besides saying the U.S. has a strong dollar policy. The U.S. always has a strong dollar policy, but a strong dollar policy means setting the right fundamentals, Bessent said. If we have sound policies, the money will flow in, he added. We are bringing down our trade deficits, so automatically that should lead to more dollar strength over time. So Bessent's comments come a day after President Donald Trump said, I think it's great, when asked if he was comfortable with the current value of the dollar. The dollar index has dropped more than 10% compared with 12 months ago. Trump said he's seen China and Japan devalue their currency, which he's found to be unfair. Investors have been monitoring for a potential intervention on the Japanese yen. They devalue because it's hard to compete when they devalue, Trump said in Iowa, where he was on a visit focused on his economic record. So, yes, so this is, again, this is getting kind of interesting here. And then I have another. The dollar could have further to fall as its decline creates a double-edged sword for America. So the U.S. dollar fell on Tuesday after President Donald Trump insisted the currency, which declined notably last year, is doing great. Nella Richardson, ADP's chief economist, told CNBC the decline of the dollar is a double-edged sword and a sign of the fraying of the economic picture. Other market watchers told CNBC the dollar is in bear territory and is likely to fall further. The dollar is in a bear market. Market watchers said on Wednesday, as one warned, the weaker greenback is a double-edged sword for the U.S. economy. Tuesday saw the dollar suffer its worst one-day slide since April, when Trump's so-called Liberation Day announcement sparked what became known as the Sell America trade. The decline came after the president told reporters in Iowa he believes the dollar is doing great. So let's go down here. Trump has long touted the benefits of a devalued U.S. dollar in relation to international trade and openly lambasted countries that intervene in foreign exchange markets to lower the value of their own currencies against the greenback. It doesn't sound good, but you make a lot more money with a weaker dollar than you do with a strong dollar, he said in July, adding that the ideal scenario is not an extremely weak dollar, but a moderately weaker one. A strong dollar dampens tourism and means U.S. suppliers can't sell anything, he said. A weak dollar can provide a boost to the domestic economy, for example, by making U.S. goods more attractive to overseas buyers and boosting exports, or bolstering the value of American firms' foreign earnings when they are converted back to the U.S. dollar. Despite Trump's insistence that the decline of the dollar is great news for the U.S., there are also negatives attached to a weaker currency, like pricier imports or a loss of confidence from investors. Speaking to CNBC Squawk Box on Wednesday, Nella Richardson, ADP's chief economist, dubbed the decline of the dollar a double-edged sword. It does make U.S. exports more competitive abroad, but a weaker dollar at home doesn't always have the confidence of markets. And that confidence is going to be very important as we look at other things that are a struggle for the U.S. economy, like sticky inflation, like high deficits and debts, and the need to sell treasuries both domestically and abroad. Richardson argued that the decline of the dollar meant the puzzle of the U.S. economy had become increasingly complex. The headline numbers don't tell the whole story, and that dollar weakness is a sign of the fraying of that story, even though the headline numbers objectively are strong, she said, referring to data points like the unemployment rate and economic growth. If you knew nothing about the last year but just saw the headline numbers, you would capture a very strong U.S. economy that would suggest a stronger dollar and an interest rate policy that was not going lower. But that is not where we find ourselves today. And it, kind of gets in. She gets into a conversation on the K-shaped economy. The dollar bear market of where it's at. But again, I have tendency to agree with Donald Trump here on this one, and that is that the goal is not to have an extremely weak U.S. dollar. The goal is to have a moderately weaker U.S. dollar, because that is going to lead to more exports from the U.S. It's going to lead to a lot of better economic numbers here at home, and I think that's what you want, at least for the short term. Now, while the dollar is in bear market territory, meaning that it's down, probably 20% over the last, 3 years, again, that's not a horrible thing. It's not a horrible thing. And like she said, it is a double-edged sword, because, you don't want it to go down too far, right? You don't want it to go down too much, because if it goes down too much, like she said, then, you might start to end up with some issues in your treasury market or your bond market, because you might start to see a loss of confidence, which would lead to rates, going up, because, they deem there to be just more risk. So again, it's something to keep an eye on, but it's nothing to be, I don't think, nothing to be panicked about at the moment. Now, I just want to go back to this yen thing for a minute. So, because again, Scott Bessent and the president, they are right here. Like, what happens is the standard MO especially for Japan and China, is to, as the US dollar weakens, they try to automatically go to currency devaluation. They try to devalue their currency because they rely very, very heavily on exports, so they're always trying to get their value better than the dollar. So when the dollar weakens, that makes it really hard on them, because that means they got to really get the devalue chain going there pretty strong. So, and that has caused them issues. I mean, they've seen a lot of spike ups in their interest rates, a lot of upheaval in the Japanese bond market the last few weeks. So this is definitely worth keeping an eye on to see ultimately what happens with this. I do have a couple things, and I won't be able to cover it tonight. I'll probably save that for next week. But again, I don't think that this story here with the yen and the kind of Japanese economic issues, I don't think that's going anywhere. So like I said, I will bring kind of more information on that next week. So, but a good thing to keep an eye on there. Now, as I had mentioned a little earlier, mortgage demand drops 8.5% as interest rates swell to the highest level in 3 weeks. So last week, the average contracted interest rate for the 30-year fixed rate mortgage with conforming loan balances increased to 6.24% from 6.16%. It had actually gotten down to, I think, 6.06% in the last week or two, but now it jumped back up to 6.24. So applications to refinance a home loan dropped 16% for the week. Applications for a mortgage to purchase a home were essentially flat. So after dropping sharply, mortgage interest rates rose last week for the first time in a month. That pushed total mortgage demand down 8.5% compared with the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. The average contracted interest rate for a 30-year fixed rate loan with a conforming mortgage at $832,000 was, again, 6.24%. As a result, applications to refinance a home loan dropped 16% for the week, but they are still 156% higher than the same week 1 year ago. That is because rates a year ago were 78 basis points higher. FHA refinance activity bucked the overall trend and increased as FHA rates remained almost 20 basis points below than conforming rates. So again, that's good to see. So again, I would, you'd love to see mortgage rates get back into the fives, even, and like I said, I I think that, again, even if the Fed only cuts the rates 2 more times, that probably gets us back into the high fives. Interest rates rise, maybe around like 5.75, 5.85%, something like that. Again, not bad. Historically speaking, that's still a very good rate. But again, like I've said this for a while now, like you're not going to see, for anybody out there hoping that we're going to get back to 3.5%, 4%, 4.5% interest rates. Yeah, you're not going to see that again for a long, long time. Nor, and I will say it this way too, nor should you want to, because I think if you see interest rates like that, that means something catastrophic happened. That means our economy literally blew up, and like '07, '08 all over again. So we don't want to see that. Um, so we're again, everyone. I think everybody's going to have to get used to this new rate environment where rates are going to be in the fives or in the sixes. Like this is where interest rates are here to stay for quite a long period of time. But like I said, I am still hopeful though that rates will get back down into the high fives. Like I said, hopefully, 5.70, 5.75, 5.80, something in that neighborhood. I think if we could get down to that pace, would just dramatically help things out and would get things really, really moving. So, all right. This was really interesting. So Elon Musk's $20 billion spending plan signals Tesla of yesterday is gone. So after capital expenditures fell in 2025, Tesla expects spending to more than double this year as the economy pours money into robotics and driverless technology. Forget the Tesla wrote analysts at Canaccord Genuity, a note following Tesla's fourth quarter earnings report. Tesla's annual revenue declined for the first time on record last year as auto sales dropped 10%. So I talked about this a little bit before, and I talked about how you have a lot of companies that have tried to pivot from their main thing. And like, what's Tesla's main thing? Well, obviously cars are the main thing. And they're now trying to pivot to become this robotics and AI company, really shifting to self-driving cars and things of that nature. And it's very interesting. And if there's anybody out there that could pull it off, it's got to be Elon. However, I just caution that the history of corporate America and Wall Street is littered with the companies that have tried to do this kind of a massive strategic pivot to try to change either from one industry to another industry, or try to change from this one main product to another main product. They have failed miserably because it is insanely difficult to do something like this. To pull off something like this is insanely difficult. So I find all this very fascinating with Elon, and we will have to keep our eyes on this and see what's happening. It's also interesting. Elon, I think Elon's net worth. I had actually been saving some articles because I was actually gonna do a little short video, like the videos that I put out all week, all Monday through Friday. I was actually going to do a short video on Elon, because Elon's net worth is now up to, I think, almost $700 billion. I mean, it's his net worth is insane. But with the pay package he's been granted here, with just the amount of wealth that he has, Elon will be the first trillionaire. I don't think there's any doubt about that at this point. Who knows? Maybe it takes him another 5 years or 6 or 7 years or 8 years to get there. But he's going to get there, and he's going to be the first trillionaire. And and then when he gets there, I think there's going to be a whole lot of interesting conversation about should somebody be a trillionaire. I think you're going to have a lot of that conversation at some point when he does get there. But like I said, I'm going to save some of that for, like I said, the other episode that I'm doing. But I just like to note this. I just like to follow it because not so much that Elon is doing this. I don't fault him for wanting to do this, but because again, I think he is taking the company in the right direction. I'm just saying from a business standpoint, from a strategic standpoint, a strategy standpoint, this is fascinating to watch. And I think that someday, one of the things, when I was in business school, when I was in undergrad, when I was in graduate, one of the things you're going to look at, one of the things, if for anybody who hasn't done that yet, or is maybe looking to do something like that, one of the things you're going to do is you are going to do a lot of Harvard Business Review case studies. You're going to look at a lot of Harvard Business Review case studies, and a lot of really interesting ones. That was one of my favorite things was reading about a lot of the different, especially when I went to get my MBA, when I went to get my doctorate. I think the best part about that I loved was it wasn't the work, it was the conversations. I think anybody who's been through like a doctoral program or been through an MBA program, they will tell you like one of the best things about it, the thing that you miss the most is the conversations, because I was fortunate to be in some class with some just incredibly accomplished people, people that were entrepreneurs that had started companies and had ran companies for a long time, other people that worked at major Fortune 500 companies, other people that were just high up on the totem pole in corporate America, but people with a lot of experience at managing people, at starting divisions or new product lines and growing those product lines, people that had a lot of experience at scaling businesses, people that had a lot of experience with startups and IPOs and all this great fun stuff. And that's what you miss at the end of the day. I miss reading about these business case studies and then going in and having these really deep, in-depth conversations. I mean, that to me was the goal. That was the really fun part about the experience of going through graduate school. So I miss that. I wish, the friends that I still have from going through school, that's the one thing we kind of talk about all the time. And it was great. It was a lot of fun. I loved it. So it was a great experience to go through. So like I said, that's why I'm really looking at this. I'm really looking at what Elon's doing here, and I'm with a fascinated eye. And I'm looking at this, and I'm going, this is going to make a beautiful case study one day, especially if he can pull it off. If he can pull it off, might be one of the great business case studies of all time. I undoubtedly it will, if he can pull it off. But we'll see. Like I said, there is no foregone conclusion here that this is going to work. And this is going to turn out, I mean, like I said, Elon thinks that it's all going to be like Star Wars. We're all going to have our R2-D2s and C-3POs running around our houses and everything. Maybe that will happen, and maybe it won't. We'll see. We'll have to keep an eye on it. So, all right, let's shift gears for a minute. Let's talk about some ACH network stuff here for a minute. I have this great. I always like to share this PDF with everybody. Now this is, and I'll let me make it smaller here for a minute before I make it bigger. So here is, it's too small. So here's the PDF, and basically the ACH NACHA, that's what everybody who's watched the show knows that is my favorite acronym for the thousands of acronyms in banking. My favorite one is NACHA. NACHA for the ACH network. So they put out this lovely infographic, usually quarterly, and I love to go through this just because it's a great way to point out, what's going on in payment activity, what's going on with payment volumes right now, so that people can get an idea here. So let's blow this back up here and take a look at this. Take 2 minutes and run through this. So this is the So this is the 2025 ACH network volume and value. So this is for the whole year of 2025. So what do we got here? 25.2 billion payments total, going up to 93 trillion. That is just an amazing, the 13th straight year of value increases by more than $1 trillion. So amazing. 2025 volume, 19.6 billion debits versus 15.6 billion credits. The 2025 value, $31.7 trillion in debits, 61.3 trillion in credits. 2025 value is up 7.9%. 2025 volume up 4.9%. So 141 million, big volume, nearly 141 million payments a day were made on the ACH network, up 7 million from last year. B2B, business to business volume increased to 9.9%, going from 7.4 billion in 24 to 8.1 billion in 2025. 103, the big reach. So last year's ACH payment volume translates to nearly 103 payments for each American. 2025 volume breakdown. So basically, what were payments that were made over the internet? They were up 6.1% at 11.4 billion. Direct deposit, ACH direct deposits, up 1.7% to 8.7 billion. Healthcare, spending on healthcare is up 7.3% at 484 million. And P2P, so peer-to-peer payments, up 19.8% at 470 million. So now same-day ACH 2025 optimized for speed. So payments totaling 1.4 billion and 3.9 trillion. So amazing. So the volume there, 2025 volume, 1.4 billion. 2025 value is at $3.9 trillion. So 821 million in debits, 626 million in credits, 1.3 trillion in debits, and 2.6 trillion in credits. 2025 volume up 16.7%. 2025 value up 21.4%. So here are some facts here real quick. So last year saw an average of 5.6 million daily same-day ACH payments. The daily total average value of last year's same-day ACH payments was 15.6 billion. 2025 marked the second straight year in which same-day ACH payment volume surpassed 1 billion, and the value of those payments exceeded $3 trillion. So amazing. Like I said, I love that they put out this PDF. It makes it really easy to kind of break down and understand what's going on in the payment volume space, as far as what's going through the ACH network. And these are just staggering numbers, and you can see how different payment rails are just exponentially increasing. B2B payments, peer-to-peer payments. Obviously we all know about Venmo, Cash App, Zelle, and their volumes just continue to increase. That's nothing shocking there. So. And again, speak of the devil, right? So Zelle network expands by 15%. So most of the 337 financial institutions that were added to the network last year were small community banks and credit unions. So hundreds of small banks and credit unions joined the Zelle peer-to-peer payments network last year, parent company Early Warning Services said Tuesday, expanding the total number of financial institutions using the service by about 15%. Most of the 337 banks and credit unions that signed on to join Zelle or went live on the network in 2025 have less than 10 billion in assets, the payment company said. The service has 2,200 financial institutions at the end of 2024, a spokesperson said in an email. That is basically almost about half the banks in the country. That means there were about 2,537 banks and credit unions connected to the peer-to-peer payment system as of the end of last year. The Scottsdale, Arizona-based company intentionally targeted financial institutions in rural areas and those that cater to underserved communities through a pair of partnerships, a spokesperson said. One of those partnerships was with Valeria, a St. Petersburg, Florida-based credit union services company that focused on financial institutions that serve non-white customers. EWS also partnered with Bridgewater, New Jersey-based payments infrastructure firm Alacrity, to embed Zelle into the firm's services, according to the release. This new relationship aims to help community banks and credit unions integrate Zelle through existing infrastructure, the release said of the Alacrity partnership. EWS worked with those companies specifically to expand its reach among smaller banks. Zelle general manager Denise Lennerhart said in the release, the deployments look very different at a rural community credit union than at a major metro bank, and not every institution starts with the same tech stack, she said. Early Warning Services boasted in the press release that around 80% of accounts at U.S. banks and credit unions are now connected to Zelle. Nonetheless, its 2,537 total at the end of last year still covers only about a quarter of the nation's 8,710 federally insured financial institutions. Now, you got to hold on for a second. So there are basically about 4,500 banks in the country. There's another basically about 4,100 credit unions in the U.S. So as far as banks go, they, like I said, they're approaching about half the banks in the country right now, but only a quarter of all the financial institutions between, like I said, between banks and credit unions. So many of the nation's largest banks, including JP Morgan Chase, Wells Fargo, Bank of America, PNC, and Capital One, are part owners and longtime users of Zelle, making smaller community banks one of the few avenues for the network's growth. So, and if I could give everybody just a little bit of history here on Zelle. So, obviously, Venmo came along, and then PayPal bought Venmo, and then with that backing from PayPal, Venmo really began to grow. Square originally, or then bought Cash App, and then grew Cash App. Square then became Block. Block owns Cash App. PayPal owns Venmo. So now Venmo and Cash App have become the two premier peer-to-peer payment platforms. So banks, obviously getting very nervous about this, decided that they needed their own kind of product. So the big banks got together. They created this company called EWS, Early Warning Services, and then EWS created Zelle, the Zelle platform primarily for banks and banks to use. So all the big banks are basically on Zelle. The problem is Zelle has not really been that affordable for a lot of community banks. Now, I think a lot of banks are kind of biting the bullet because they're looking at, they're looking at what the customer wants. They're looking at the overall customer experience. And if they got, especially the younger generation, especially Gen Z. So if you want to attract the Gen Z customer, you're probably going to really need a good P2P platform. And the only one really out there for them right now is Zelle. Because they're not going to hook up on Venmo or Cash App. So that's a little bit of the history behind Zelle right there and EWS. So, but obviously, Zelle continues to grow, which I think ultimately is a good thing, because for at least for banks, we got to have that option to have the bank got to have some kind of option out there to be able to get a payment platform to use. And Zelle is, whatever you might grumble about the cost, it is the platform that's out there right now. So okay, all right. I want to do some talking about Trump accounts, but I'm gonna wait on that. So this is so I want to switch gears for a few minutes. This is usually the time of the night where I like to bring you guys economic indicators for next week, which is what I've brought up on the screen here. So I like to give everybody the economic indicators for next week. I also like to go over the 5 episodes that I put out this week to tell everybody what I brought out as lovely content. So give me just a second to get some water here. All right, so let's go. So what do we have as far as economic indicators coming out this week? So on Monday, February 2nd, we have the OPEC meeting. We have the manufacturers PMI. We have the ISM manufacturing PMI. On Tuesday, February 3rd, we get the JOLTS open job openings. We get the API weekly crude oil stock. On Wednesday, February 4th, we get the ADP non-farm employment change, the services PMI, and the ISM non-manufacturing PMI. On Thursday, February 5th, we get initial jobless claims and continuing jobless claims. And then finally, on Friday, February 6th, we get average hourly earnings, non-farm payrolls, participation rate, private non-farm payrolls, unemployment rate, Michigan consumer sentiment, U.S. Baker Hughes oil rig count, and consumer credit. So a lot of economic indicators coming out this week. We'll get a lot of labor market information, which people will be looking, looking very close at some of this stuff. So, so we'll keep an eye on that. So that is the economic indicators for this week. Now, let me shift gears and let me tell you guys a little bit about the 5 episodes that I put out this week. And then after I go through those 5 episodes, I'm then going to give you guys some banking news for this week, because I have some pretty interesting things that happened. So, all right. So on Monday, I did the episode was called "Are Dallas and Miami Becoming the New Wall Street?" So with the announcement of Nisi expanding in Dallas and Wells Fargo moving their wealth management HQ to Miami, What does this mean for the future of Wall Street? So since COVID, many of the largest financial firms in the US have been making the move south into Texas and Florida. Given the political landscape and continued advances in technology, this trend seems certain to continue. So again, a very interesting episode. Got a lot of response, a lot of comments, a lot of feedback on this one. People thought that this was very interesting. I think that this is I think this is kind of flying under the radar a little bit right now, but I find this to be one of the most interesting things right now because one of the things I mentioned in that episode was that if you look at the history of the country, you look at the history of the U.S., right? One of the things that's very interesting is that when the country first started, Philadelphia used to be the financial center of the country. It's obviously where the nation's capital originally was set. During George Washington's time, when the first bank of the U.S. was chartered right here. That was basically the U.S.'s first central bank. That everything was basically here in Pennsylvania. It was here in Philadelphia. But then around, obviously, we created the nation's capital. We built the White House. The president went down there. We built the Capitol building down there for everybody on Capitol Hill. So obviously the political power moved out of Philadelphia down to Washington, D.C. But then the financial power left there around in the 1870s. And obviously there was a big panic in 1873. Which kind of accelerated some of that. But basically, the 1870s was when Wall Street really saw its rise to power. That's really when the vast majority of the financial influence kind of left Philadelphia and went up to Manhattan, went up to Wall Street. And again, that had been slowly happening over the course of a few decades, but it was in the 1870s that New York really emerged as the financial powerhouse, and then in the coming decades would emerge not only as the financial center for the US, but the financial center of the world. So we've already seen that transition. The question I have now is that are we in the beginning stages of the transition away from New York as the financial center and perhaps down to a kind of a split almost between Texas and Florida? There's just a lot of things happening in Texas right now. I mean, they're going to be opening their own stock exchange. Like I said, I talk about in that episode, Nisi is going to be moving down there, moving a lot of operations down there. There's a large number of the publicly traded firms that are on the stock exchanges are headquartered in Texas. So it's a very, like I said, I think it's one of the most interesting trends out there that perhaps people aren't paying as much attention to. So anyway. All right, like I said, check that episode when you have a chance. So, and then on Tuesday, I did a regulatory update for the first quarter of 2026. As we roll into 2026, it's time for a regulatory update. So, community bank deregulation is top on the list with 1071 rule, stablecoin debit card interchange proposal, and BSA reporting. In addition, other major regulations around the 1033 rule, also known as open banking. Regulatory relief legislation, the ACRE implementation, GSEs, and federal home loan banks are considered. So this episode looked at ICBA's advocacy in action for the first quarter of 2026. So again, I love doing that episode. I love the advocacy in action from the ICBA just because it's a 2-page PDF. It gives you a quick rundown of what I call are the hot button topics. The hot button regulatory topics in banking. So if you know a lot about banking, you might want to check that out just to stay on top of what are the current trends, what's going on there with regulation at the moment. If you know absolutely nothing about banking and you just want a quick 15-minute overview of what are all the main regulatory topics, why you should care about them, how they could have a major impact on banking, go watch that episode. So, all right. On Wednesday, the episode I did was called FinTech is Coming for Banking. So the competitive landscape in banking is shifting. With the influx of banking charter applications in 2025, Fintech players such as PayPal are seeking to officially enter the banking space. Bank charter applications are expected to continue to increase in 2026, with fintech, digital, and crypto players all looking to get into banking. What does this ultimately mean for banks, regulators, and fintech? So everyone is going to have adjustments and challenges. This episode examined a couple articles from Bank Director. And, so basically, yes, our landscape is changing, and it's going to change for everybody. So the fintechs that are getting into banking, they are going to have to deal with major regulation for the first time. So they're going to have a lot to deal with, which, we'll see how that plays out for them. Banks are going to have a lot to deal with, because they are going to have to make adjustments to compete against the fintechs, the digital firms, the crypto firms that are coming into the banking space. And then finally, regulators are going to have to change, because regulators are going to have to adapt to what they're seeing now in these new companies. I even think that we might have to have some, dare I say, consolidation of the regulators, because I think not only do they need changes, maybe we don't need as many regulators going forward. I'm sure there's some people out there that, would very much not like to hear me say that, but it's like I said, it's where I think things are going in the regulatory space. Then on Thursday, I put out, how can banks best utilize agentic AI? So you have two different types of AI. You have generative AI, but then you have agentic AI. Now, generative AI is what creates content. Like, that's what people use to, they're creating deep fakes, or they're creating videos or artwork, pictures, music. That's all generative AI. Agentic AI is the type of AI that actually does stuff for you. Like, you could think of what was known as like an agentic agent. But many financial institutions around the U.S. are already experimenting with agentic AI. Some of the areas that are currently being worked on include fraud detection, security enhancements, efficiency, and customer service. So how can banks put agentic AI to work? So this episode looks at the following potential use cases: contact center agents, processing ACH returns, loan underwriting, and money laundering monitoring. So again, I thought this was a really good kind of quick episode looking at agentic AI and how it's being used in banks, and offering some very good use cases there as well. So, okay, and then finally on Friday, coming out today, I did, are banks ready for the major deposit reforms that are coming? So major deposit reforms are coming. There are currently 3 bills being considered in Congress and the Senate. They include the Keeping Deposits Local Act in the House, the Main Street Depositor Protection Act in the Senate, and the Community Bank Deposit Access Act, which is also in the House. These 3 bills will change the way deposits are insured, transferred, and managed. This episode proposes 5 items that bank leadership should be considering: strategic assessment, scenario analysis, stakeholder engagement, economic impact, and implementation and guidance. So, this is a huge topic. Insurance reform is a major topic for banks, but it should also be on the radar of consumers and businesses, especially businesses, because businesses are what could benefit the most from this reform. I don't think there's going to be a whole lot of reform for consumers there. Consumers are already secured up to $250,000. I don't really see a whole lot of change with that. But for businesses, they're talking about business accounts being insured for as high as $10 million. So that could be a massive, massive change there for businesses out there. So again, and I was waiting for an article or not an article. I was waiting for kind of like some information that was going to come along that was going to lay out the 3 pieces of legislation, what they were, why they're important, how they're different and yet similar. So I thought this was a really good episode. I hope people go check that out just to get a little bit more information on what's going on with deposit reforms. So, okay, those are the 5 episodes that I put out this week. Now, let's get to some banking news, shall we? So let me get some of my papers together here. Hold on, bear with me for just a second as I kind of sort through some of this stuff here. So, okay, here we go. Factory orders increase in November. Wholesale inventories increase in November as well. ICI is named as an ICBA preferred service provider. So ICBA announced that a company called ICI as a new preferred service provider to help community banks assess vendor offerings and negotiate favorable contract terms. So kind of interesting there. Rural Economic Index climbs to its highest level since 2023. The Creighton University's Index of Rural Economic Conditions climbed to 52 in January, its highest reading since July of 2023. Consumer sentiment is up in January and increased 6.6%. Blog post shows positive effects of community banks and federal home loan banks partnering. So a new blog post from ICBA says that with policymakers re-examining housing finance policy and exploring ways to improve housing affordability, building on the success of the federal home loan banks should be a top priority. The blog post from ICBA's Senior Vice President of Mortgage Finance Policy, Ron Haney, spotlights how the federal home loan banks have been an integral part of helping community banks serve the needs of Main Street for over 90 years, supporting community development projects and access to liquidity. Senate panel advances digital assets bill without credit card routing amendment. Yes, so this was major news this week. So the Senate Agriculture Committee voted 12-11 to advance the Digital Commodity Intermediaries Act without bipartisan support or the inclusion of the ICBA-opposed Credit Card Competition Act. So this bill is the Senate Agriculture Committee's piece of digital assets market structure legislation and would provide new authority to the Commodity Futures Trading Commission to regulate digital commodities. The bill will eventually be merged with the Senate Banking Committee's proposal and will need 60 votes to pass the full Senate. So again, really need to keep an eye on this one. ICBA supports a Senate bill to close the ILC loophole. So ICBA expressed strong support for bipartisan legislation to close the industrial loan company loophole, which allows commercial companies to own full-service banks without full regulatory oversight. A loophole in the Bank Holding Company Act allows commercial and fintech companies to own or acquire ILC charters in a handful of states without being subjected to federal consolidation supervision. So again, I mean, that's been on not just the ICBA, but the American Bankers Association. That has been on their wish list for a very long time. So we'll keep an eye on that and see, what becomes of that, if anything. So ICBA seeks community bankers for AI task force. So that's kind of interesting. ICBA shares feedback on core providers with the OCC. So the ICBA shared input on community banks' relationships with core service providers and other essential third-party service providers to help identify pragmatic actions to reduce the burden on community banks. So independent bankers share word-of-mouth marketing tips. I'll probably go over that in another episode because I thought there were a couple of really good things there. And then durable goods orders were up for November. So, and then I do have a couple other news things I wanted to share with everybody. Let's see here. I have here. What I wanted to share anything else there with that. Yeah, so this is kind of interesting. So new rules governing prediction markets are in the works at the Commodity Futures Trading Commission. Barron's reported, citing prepared remarks by the agency's chairman, Mike Selig, for a joint event with the U.S. SEC. According to the report, Selig said he had directed his staff to start drafting clear standards for event contracts that provide certainty to market participants. So again, that is a very that's a very interesting one, a very interesting development. I've been following a lot of these developments with prediction markets. A lot of companies looking to get in prediction markets, mainly Robinhood. Coinbase wants to get into prediction markets. There are a number of companies right now that are really keeping an eye on prediction markets and trying to get into that space. So again, very interesting there. We'll have to look at it. And then just an update on the whole Credit Card Competition Act. So Visa CEO Ryan McNerney pushed back on the Credit Card Competition Act being proposed in the U.S. Congress and backed by President Donald Trump, citing far-reaching negative consequences, such as consumers and small businesses, reduced access to credit, elimination of rewards, weaker security protections, and less innovation. McInerney said the company has been explaining to Capitol Hill lawmakers why the market is working well. There's no need for government intervention. It's very harmful, and it's just simply not needed, he said during the company's latest earnings call. So, yeah, I mean, of course, he's going to come out and say that. But again, I think that a lot of consumers out there, I just think a lot of consumers would be, very, very happy to have, a lot of that checked or reduced. So I'll just put it that way. So, all right. Now, let's get back to some of our articles here. Where did I leave off here? Okay. Oh, I left off at the Trump accounts. So I thought this was kind of interesting. A lot of news coming out on these Trump accounts. Obviously, the Trump accounts that were something that were passed as part of the one big beautiful bill. But now we've got some interesting developments here. So we got JP Morgan Chase and Bank of America to match 1,000 U.S. contributions to employee Trump accounts. So JP Morgan Chase, Bank of America, and Wells Fargo said Wednesday in separate releases that the firms will match the U.S. government's one-time $1,000 contribution to children's retirement savings accounts for eligible employees. The latest corporations to announce such a measure, the so-called Trump accounts, are part of a pilot program that deposits $1,000 from the U.S. Treasury into tax-advantaged accounts for eligible children born in the U.S. between January 1st, 2025 and December 31st, 2028. So, again, I think this is amazing. I mean, when you look at some of the numbers here, I don't think that they really show them in this article. This is a short article here on it. But, they were Scott Bessent had put out some numbers where, it was just amazing. Like, he talked about just the potential growth of this stuff. So, but here's another article here that says basically Bessent teases big announcement as Trump accounts reach 500,000 signups. Treasury Secretary says additional states philanthropists will be revealed at a White House summit. And so Treasury Secretary Scott Bessent said big announcements are coming ahead of Wednesday's White House summit on the Trump accounts. The program would provide 1,000 in federally funded investment accounts to every U.S. child born between 2025 and 2028, with the potential for accounts to grow significantly over time. Bessent said additional states and philanthropists will be announced at the event. We're going to have some big announcements today on this. Let's see here. Do they show? I was hoping they were showing kind of some of the. I'm not going to show that there. So, all right, and then let's go over here. So, how do you open one of these $1,000 Trump accounts for your baby? So that's a great question. So the program designed to give youngsters an early financial boost will officially begin on July 5th, 2026. So the program kicks off on July 5th. President Donald Trump promoted the Trump accounts during a summit on the 28th. We're going to put $3 trillion to $4 trillion of wealth into the hands of young Americans who otherwise would have really started out with nothing, Trump said during a speech at the Treasury event. The federally funded pilot program puts $1,000 each into savings accounts that American-born babies will be able to access after they turn 18. So here's the eligibility. So the program officially starts on July 5th. But any baby born in the United States between January 1st, 2025 and December 31st, 2028 is eligible. The child must have a valid Social Security number to receive a Trump account. The accounts will be managed by parents or legal guardians after they are opened. So parents and legal guardians have two ways to enroll their kids. The first way is to use the newly created IRS form 4547, which can be, that's pretty funny, 4547. Which can be found online. The IRS form will be filed with a parent when a parent submits his or her taxes. The second way to wait until the summer of 2026 and register through an online portal. The portal is not yet public, but a general website for the program has been activated. So yes, and then here is the actual website. This is trumpaccounts.gov. Trump accounts jumpstart the American dream. We've built long-term financial security for millions of children by creating tax-advantaged investment accounts. So basically, here's what it would look like. So Katie's Trump account, basically, I guess you could get it on a mobile app, see what's going on, and launching July 5th. And then it just goes down here. Big things start small. I'm just wondering if they, your account balance will grow over time on its own, whether you choose to contribute additionally or not. You may contribute up to $5,000 per year to accelerate gains. So again, like I think this is fantastic. Look at this. So this is at like age 18. So you could contribute what, 6,000, or you would have $6,000 there if you could contribute nothing. So you contribute absolutely nothing, and by the time you're 18, you'll have $6,000. If you contribute $250 a year, you'll have $19,000 by the time the kid is 18. Or if you contribute $5,000 a year, you could have up to $271,000 in there. And again, this is just by the time they're 18. So, and then at the age of 20, look at 27. So if you contribute nothing, by the time you're 27, you'll have 15,000 in there. You would have, if you contributed just $250 a year, you'd have $51,000 in there. Or if you contribute $5,000 a year, you would have $742,000 in there. And again, the age of 55, again, pretty amazing. So if you contribute nothing, you have $243,000 in there. If you contribute $250 a year, $878,000. And if you contribute to $5,000 a year, you'd have $13 million in there. That's pretty astonishing. And you can see here a lot of the companies that are participating in this: Dell, MasterCard, Charles Schwab, Chime, BlackRock, Block, Uber, Visa, SoFi, Charter Communications, BNY, Michael and Susan Dell, Ray and Barbara Dalio. So, I mean, again, yeah, I mean, just like this, I mean, like I said, this seems pretty astonishing. Now you do have like the 529 plan that is out there that a lot of people take advantage of. I think this might prove to be better than that over the years, but we will have to see. But let's go back to this article for just a second. Let's just see here. As far as investments, so your account balance will grow over time on its own, whether you choose to contribute additionally or not, the official website stated. Family members are not required to pay for the accounts or contribute additional money, but do have the option to donate a maximum of $5,000 per child annually to the accounts. For example, if a child account receives the maximum contribution of $5,000 per year, by the time the child is 18, the account could have $303,800 in it, according to data provided by the Trump administration. If a child does not receive any donations, the account is expected to have $5,800 in it by the time the child is 18. Families will be able to deposit their Visa cashback rewards directly into Trump accounts, the president announced during his January 20th speech. Some children may receive a boost in their accounts from other donations, such as money from philanthropists Michael and Susan Dell. White House announced in December 25th, described the terms of the Dell gift. The first 25 million American children aged 10 and under living in zip codes with median incomes below $150,000 will receive an additional $250. Children won't be able to access their Trump account until they are 18 years old. The account holder will then be able to withdraw their funds or continue letting it grow with the advantages of a traditional IRA. There won't be any penalty if the child withdraws money from a qualified expense, such as college or buying a home. A parent will not be able to access his or her child's account after the child turns 18. So again, very interesting. So you'll be able to pull money out of there and use it for basically college or buying a home without penalty, which again is fantastic. So I think that these Trump accounts, I mean, it's like, again, this really sounds amazing. I wish I would have had this for my kids because I absolutely would have jumped. I would have jumped all over this. Definitely would, I mean, again, because you could have, again, you could get grandparents, grandparents could give you $250 or $500 a year to put in for the kids. And that could really help to grow the account. But again, yeah, I just think it's amazing. Like, because again, it's a big deal. I mean, even if you have like, by the time, say by the time your kid is 18, and they're getting ready, like I said, if they're going to go to even if they don't go to college, but think about if you just have 20 or $30,000 sitting there, and now you kind of give them some money just to get started in life. They to start with something. And basically it's like, oh, hey, if you need some money to go buy a car, you have some money to go buy a car. If if you need some money, if you're going out and do, just to get kind of rolling in the world, buy clothes, buy the things that you need to get rolling. Maybe you're moving into an apartment, you need money for furniture, or buy some silverware and a toaster and a microwave, whatever. Again, I mean, like I said, I think it's fantastic. It could give the opportunity for some people to really save some good money for their kids. And again, if they can leave it there and not touch it, again, by the time they're 30 years old, they could potentially have an incredible chunk of change sitting there by the time they're 30. Imagine, like, most people don't, like, you kind of get, let's say you go to college, you get out of college, you start your first corporate job. Maybe you start contributing to your 401k when you're 22, 23 years old. Of course, you're not making much, so you can't put that much money in there, but you start with something, right? And again, and most people don't really have very much in their 401k. I mean, usually, they're not able to build, $100,000 in their 401k until they're probably into their 30s. And then from there, it really begins to build. But imagine if you have this, right? And imagine if you already have $100,000 by the time, you're 22 or 25 years old. I mean, the compounding of that over the next 30, 40 years is amazing. I mean, you could absolutely grow that to a few $1,000,000 over the next 30, 40 years. I mean, no problem. So again, it's just like I said, I think it's really, really amazing what they're doing here. And we'll keep an eye on it, and I'll report more back as things have it. But basically, the official sign up July 5th, but you can go on the website and at least put your name in there right now. I would do that because it looks like, again, if you're one of the first, 25, if you're one of the first 25 million or something to sign up, like Michael Dell and his wife and some other philanthropists will be kicking some money into this. So again, could be some pretty amazing things down the road. So, all right. Let's jump into some other things here real quick. This is great news. Century Aluminum to construct first U.S. aluminum plant in more than 40 years. The project is expected to create 5,000 direct and construction jobs. I mean, just absolutely amazing. And this is what Trump's policies are doing for us. This is the first aluminum aluminum plant in 40 years. I mean, think about how insane that is. How could we not have built a new aluminum plant in the last 40 years? Like, it's crazy. So Illinois-based Century Aluminum Company has entered into a joint development agreement with Emirates Global Aluminum, EGA, to construct the first new primary aluminum production plant in the United States since 1980. Primary aluminum production involves smelting aluminum to produce new aluminum metal. This differs from secondary production, in which existing aluminum is recycled. The new plant, to be built in Enola, if I'm saying that right, Enola, Oklahoma, as previously announced by EGA, is expected to produce 750,000 tons of aluminum per year, larger than previously envisioned and more than doubling current U.S. production. The Enola plant will create 1,000 permanent direct jobs at the facility and 4,000 jobs during construction. So just absolutely phenomenal. Phenomenal. How the U.S. rare earth deal with the Trump administration came together. So U.S. rare earth CEO Barbara Humpton described in an exclusive interview with CNBC's Brian Sullivan how its deal with the U.S. government came about. So the U.S. will provide $1.6 billion to USA Rare Earth, subject to conditions, and will also take an equity stake in the company. The government is taking an economic interest in the business, not a governance interest. So USA Rare Earth. Let's see here. What did he say here? So my trip. She's injected. Okay, but again, the rare earth thing is a very big deal right now, and we really need to get rare earths rolling in the U.S. One of the big things is that we actually have some mines and stuff in California, but of course, California being the state that it is, won't allow a ton of that stuff right now, and that is really hurting us. It's really hampering us. We really need them to get some of those mines back open and back rolling again. So, and we really need to take control of rare earth production here in the U.S. again. And like I said, I've talked about that a little bit in the past, but I got to keep rolling with that. So, okay, let's talk a little bit about some of the tariff things for the moment. So, Trump says South Korea is not living up to the trade deal and hikes tariffs to 25% on key imports. So, President Donald Trump said Monday that he was increasing tariffs on South Korea imports of autos, lumber, and pharmaceuticals to 25%, accusing Seoul of not living up to its trade deal. Our trade deals are very important to America, and each of these deals we have acted swiftly to reduce our tariffs in line with the transaction agreed to, Trump wrote in Truth Social post. We, of course, expect our trading partners to do the same, he added, saying that South Korea's legislation has not approved the trade agreement. So, yes, so that has not been good. And then we kind of get this follow-up. Hyundai shares fall after Trump says tariffs on South Korean autos and pharma to rise to 25%. So Hyundai taking a little bit of a beating in their shares after this announcement. So we will have to keep an eye on this. So again, South Korea, I think, has pretty much basically said that they will get on board with this and that they will get this, they'll get this sorted out. They'll get this trade deal passed. But Trump is basically giving them a little extra incentive at the moment to get this thing done. So, okay, switching to Canada. So Canada is, Carney says Canada has no intention of pursuing a free trade agreement with China. His comments come in response to U.S. President Donald Trump saying Canadian goods would be subjected to a 100% tariff if Canada makes a deal with China. Now, Carney, this moron, and he truly is a moron. He has been again Captain Resistance, Les Resistance. Up there in Canada, this moron has been systematically destroying the Canadian economy, which has just been wild to watch. This fool showed up at Davos a week or so ago and basically was just talking all kinds of smack. And then he proceeded to think that he was going to enter into this big trade deal with Canada. And Trump basically came back and was like, nah, that ain't happening. And of course, after all that smack he talked, he turned right around and basically said, "Oh yeah, no, we're not gonna sign that deal. We're not gonna sign that deal." So, yeah, this guy is just a moron, and I feel bad for Canada. I mean, this is why you got Alberta up there right now, basically threatening to secede and basically saying, "Hey, we'll come join the U.S." It's like wild. I mean, wild. They got some problems up there in Canada, no doubt. Okay, this is major news here. Trump gets a boost as Panama Canal ruling ups the ante in U.S.-China power struggle. So obviously the Panama Canal has been a big topic for the last year. So this is the Supreme Court of Panama. So the outcome from Panama's top court is widely seen as a victory for the Trump administration, which is seeking to counter any Chinese influence in the region. Shares of Hong Kong listed CK Hutchinson fell nearly 5% on the news. A spokesperson for China's foreign ministry said Beijing would take all necessary measures to safeguard the legitimate rights and interests of Chinese companies. Now, I will say this. If there is one thing that the U.S. should be fully ready to go to military action on, it is the Panama Canal. That we cannot allow in any way, shape, or form for the Chinese to take control of the Panama Canal. There is just no way. There's no way that can be allowed. In no reality can that be allowed. I mean, so if it comes to that, and President Trump comes on TV one day and says, "I'm sending our military down to secure the Panama Canal, and if China's got a problem with that, bring it on, and we will engage you." I'm down. Okay, because the amount of power that China would gain over us in terms of controlling the flow of trade through the Panama Canal, and the fact that we built the Panama Canal, the fact that it would not be there without the United States, the fact that Jimmy Carter one of the dumbest things that Jimmy Carter did was giving the Panama Canal back to the Panamanians for $1. I mean, I mean, you cannot believe how stupid that was. And he gave it back to them in good faith, thinking that, okay, you guys will just run it. But now the Chinese have really muscled in there and have really made this coup attempt to basically kind of do a backdoor take control through this company, the CK Hutchinson. And and this is a bit. I mean, I don't think people understand how big of a deal this is. So, but again, huge news. I mean, the basically the court ruling basically said, yeah, nope, sorry, CK Hutchinson has, they're not, their deals are void, and will give the a chance for the United States to get back in there and hopefully take control of these ports here in the Panama Canal. So like I said, we're gonna keep an eye on this one for sure. Okay, now this headline I think was a little misleading here. So it's basically, the trade deficit soars 94% in November. It was higher than a year ago despite tariff efforts. So yes, we got a little bit of bad news here as the trade deficit did shoot back up. It got down by, I believe, as low as 29 billion, which was the lowest it had been in 16 years. But let's read it for a second. So the U.S. deficit with its global trading partners nearly doubled in November as the shortfall from the European Union swelled. Following a month where the trade deficit hit its lowest level since early 2009, it shot up to 56.8 billion, an increase of 94.6% from October. Now, obviously, this is being painted here on CNBC as, this is this earth-shattering, horrific thing. No, I mean, the trade deficit is going to fluctuate. It's going to go up a little bit. But this number is a million times better than it was a year ago. I mean, a year ago, this was over 140 billion dollars, and now it's down to 56 billion. So, so again, if we have a little bit of fluctuation here and there, it's not the end of the world. I mean, this next month, this could be back down to 35 billion. We don't know. We have to see. But again, I'm not panicked with this. But again, I thought it was kind of ridiculous the way that they wrote the headline for this article. Whatever. Okay, now let's switch gears for a second. Let's go to last week, I'm pretty sure it was last week, I did the episode on, let me look at this up for a second. Was that last week or maybe it was 2 weeks ago? Yes. Okay. So it was 2 weeks ago. I did an episode called "With a Multi-Billion-Dollar Fraud Uncovered in Minnesota, What Does This Mean for Banks?" And I really focused in on the fact that, you've had this massive fraud uncovered in Minnesota, that this was going to come. And I was not covering this for political reasons. I was covering it for banking reasons. And I believe that this fraud is going to come back to banks, and banks have to be very aware of the fraud and should be, looking at it. Now we get this article this week, fraud concerns spread from Minnesota to Ohio. And one of the things that I said in the episode that I did was that this is going to spread. It's going to spread all over the United States. I believe that there's some levels of this fraud going on in just about every state throughout the country. So, and here was like the first article. Fraud concerns spread to Minnesota. Anti-fraud efforts were already underway in Ohio, officials said, long before outrage over Minnesota's Somali fraud spread suspicions to the Buckeye State. But yes, so they're going to continue to look at this. We should throw the book at those who found to have abused taxpayer funds. Ohio State Senator George Lang. So yes, so and so again, this is like I said, this is going to continue to be a major story for anybody who thinks that this is going away. It's not going away, and it's going to become a big thing. And I think that banks need to think about how they could get tangled up in this, how they could get stuck in this thing. So they got to think about that. Got to keep an eye on it. So I will, like I said, as more stuff comes in on this, I will continue to follow it with updates. Okay, very interesting here. We've got this blockbuster social media trial that's about to kick off. So this landmark case against social media giants Meta, Alphabet's YouTube, and TikTok is set to begin in Los Angeles Superior Court. It is the first of several high-profile legal cases against social media companies in 2026 that have drawn comparisons to lawsuits brought against big tobacco in the 1990s. Experts have said these cases could have long-lasting implications on regulation and public perception of these companies. And I want to show you another article here real quick. So jury selection to begin in high stakes social media addiction trial. So Meta's Facebook and Instagram, ByteDance's TikTok, and Google's YouTube are accused of helping worsen the youth mental health crisis. So jury selection in a high stakes social media addiction trial begins in California on January 27th. According to court documents, the trial will put big tech in the hot seat as defendants, including Meta's Facebook and Instagram, ByteDance's TikTok, and Google's YouTube, are accused of worsening the youth mental health crisis. The hearing in the Superior Court of Los Angeles County is a test case for thousands of similar lawsuits seeking damages over alleged harms caused by social media. In this particular case, a 19-year-old woman from California identified as KGM alleges that she has been addicted to social media for more than 10 years and that her constant use of the technology has given her depression, anxiety, and body dysmorphia. Starting January 27th, 75 potential jurors will be called in each morning and afternoon until at least January 29th. So I want to keep an eye on these. I want to keep an eye on these and kind of see what happens. Because again, this could have ramifications down the road with social media, how, especially with marketing, how marketing is done on social media. So we shall see. I just wanted to make note of this because I am a huge space guy. Huge space. I love space. Obviously, I'm a big sci-fi guy, loving Star Trek and Star Wars and everything growing up, everything in between. And I have been a huge Kennedy Space Center is probably one of my favorite places. I've been there a bunch of times. But this is fantastic. And I just don't know why this has not been a bigger story. So NASA is set to launch the first manned moon rocket in 50 years. 10 days. It is a 10-day trip, 4 astronauts, 700,000 gallons of fuel, everything to know about the Artemis 2 rocket. So this rocket has been rolled out there. It's sitting on the launch pad. They're getting it ready. They're just waiting for the right moment to send it off. You got the 4-person crew here. And I think they have, okay, so here is the flight plan. So if I can maybe make this just a tad bit bigger here so everybody can see it. So they are going to start out, they're going to basically get to start out here and, kind of whip around the Earth a little bit. ISPC Earth disposal, deployment, and basically then they're going to come back around the Earth and then they're going to shoot all the way around the moon. They're not going to land on the moon. They're just going around the moon. But they're going to make a trip around the moon and come on back. So, and this is basically scheduled to take about 10 days for them to do this, but obviously extremely exciting. They're basically going to go farther away in the rocket here, where you see number 11, where they're at here with 11 behind the moon. They're supposed to go farther from Earth than any other shuttle has ever gone. So again, I just, like I said, I love it. I am so excited for this. We don't have a launch date as of yet, but it's going to be soon here. It's probably going to be in the next couple weeks. And but like I said, I'm going to be watching this one on pins and needles. Can't wait for this. Super stoked and excited about this. So okay, let's jump back. Another interesting thing here, TikTok users are deleting the app with removals up to 150% following U.S. joint venture. So I didn't really foresee this. I didn't see TikTokers getting all mad. So TikTok users have been deleting the app at a higher rate since the company announced that its U.S. operations would be housed in a new joint venture. The daily average of U.S. users deleting the TikTok app has increased nearly 150% over the past 5 days compared with the previous 3 months. market intelligence firm Sensor Tower told CNBC. Some users took to social media to voice their skepticism about the new joint venture after being prompted to agree to an updated privacy policy on Thursday. Yeah, so a lot of TikTok users not happy. I am not on TikTok. A lot of people have told me to get on TikTok, but I'm not on there yet. I'm gonna wait. I'm gonna wait to see how this whole thing plays out, and then I'll see about maybe getting in there. So, all right, and let's run through a couple of bank articles real quick. So, for activist investor that I have talked about in the past for Holdco, not a great week here for Holdco. So basically, Eastern Bank eschews M&A in the face of investor complaints. Executive Friday said that Eastern, after completing a deal last October, had attained the size and scale to compete effectively. So the obviously Holdco wanted Eastern Bank to sell itself. Basically, the Eastern Bank saying, "Nah, we're good." And then judge rejects Holdco's challenge of Co-America Fifth Third deal. So after the activist investor filed an emergency motion to stall the merger's closing set for February 1st, a Delaware Court of Chancery judge denied it, saying Holdco failed to clear that high hurdle. So after Holdco basically forced, I think it was Co-America to sell to Fifth Third. Am I getting that backwards? Is Co-America buying Fifth Third? I'm trying to remember here. Okay. So Fifth Third, yeah, is buying. So Holdco basically forced Co-America to sell itself to Fifth Third, and then after they sold it, they started complaining about, "Oh no, you could have sold it for more money. This is a horrible deal." Blah blah blah. So yeah, these guys at Holdco have been very aggressively running around doing a lot of stuff, but so far not getting the results they were looking for. So, all right, Goldman Sachs to pay their CEO $47 million for 2025, not too shabby. So the payout marks David Solomon's third consecutive annual raise of 20% or more. Man, don't you wish that you were getting a raise of 20% or more every year? And likely will make him the best compensated chief executive among the 6 biggest U.S. banks. Yes, so this dude. In the vein of bank CEOs, big bank CEOs before him, the sky is the limit, baby. He is going to give himself the ridiculous pay package. SEC agrees to dismiss Gemini lawsuit. So the lawsuit regarding Gemini Earn is appropriate to dismiss because its investors have already received 100% of their money back, the SEC said. So hey, good news for Gemini there. Numora spinoff Laser Digital applies for OCC charter. So the digital asset firm is vying for a national trust banking charter, the same license for which Circle, Ripple, and Paxos were conditionally approved last month. So we will keep an eye on that. So Ally taps former acting OCC chief as policy advisor. Rodney Hood, who has served as acting controller of the currency and chair of the National Credit Union Administration, will serve as a senior policy advisor to Ally CEO Michael Rhodes. So good landing spot there for Rodney Hood. And former Citi exec sues bank alleging sexual harassment. So Citi's former global head of platform and experiences said she was subject to a campaign of sexual harassment, manipulation, and grooming involving the bank's involving the bank's wealth chief. So keep an eye on how that one plays out. And then just a couple of things here. So number of SBA COVID EIDL loans in payment plans plunges. And I'm going to make this a little bit bigger here so we can see this. So let's see here. So Small Business Administration payment assistance enrollment drops 88% to 36,049 loans. SBA ended the hardship accommodation program for COVID EIDL loans early last year, and the agency has charged off $75 billion in EIDL loans dating back to fiscal 2023. Now, look, I have talked about this a lot last year, and I have said that, I kind of changed my tune on the EIDL loans last year, basically saying that I think the EIDL loans should be forgiven. And I've gone through that in the past. I've talked a lot about my rationale for why that was, but I do believe that the EIDL loans should be forgiven. So again, hopefully maybe they still come back around to that, but we shall see. And then Finally, last thing I have for everybody here is SBA issues a waiver of suspensions to companies in the contracting program. So the SBA suspended 1,091 firms for missing financial document deadlines. They suspended firms receiving approximately $5 billion since 2021, and Administrator Kelly Loeffler claims the program was abused during the Biden administration. So the Small Business Administration has suspended more than 1,000 firms from its 8A business development program. The announced suspension of 1,091 firms comes after those businesses failed to meet a January 19th deadline to submit 3 years' worth of financial documents, according to the SBA. There were roughly 4,300 firms in the program. About half of the suspended firms have been paid in some form for contracted work since 2021, receiving more than $5 billion over the last 4 years, according to the SBA. The SBA under the Trump administration has claimed rampant fraud within the 8A program. The program previously had been a target for lawsuits from conservative-backed organizations during the Biden administration. So not good news there for people in that 8A program, but we will continue to keep an eye on that. Okay. Let me go into wrap-up mode here. So, all right, we're going to get to the story of the week and the quote of the week here in a second. But before we get to that, I need to get my banners up here. Let's go to my banners. Okay. So if you are listening to the podcast on Apple Podcasts or Spotify, please leave me some reviews, as that really helps the channel. It really helps the podcast. Any review you can leave me, hopefully a positive one, would really help out. So if you're, like I said, if you're on Apple Podcasts or Spotify, please make sure to leave me a review. Please make sure to go visit thebankernextdoor.com. Go check out the website. A lot of good things out there on the website. Make sure to subscribe to me on YouTube to get all the latest updates via post. Like this weekend is a perfect example. I had to move Strategy Room from Saturday night to Friday night. I put that announcement out yesterday. I also like to put announcements out as to far like what are the main topics that I will be covering during Strategy Room. I also put out usually a post on Sunday night where I lay out, okay, here's all the episodes that I have coming out for this week. So if you want the latest and greatest news, follow me on, like I said, give me a follow on YouTube, so you can get all those latest posts and everything that comes up. If you have any comments, questions, or topic recommendations, you can email me at info@thebankernextdoor.com. So I always love getting feedback from people. And like I said, if you have any questions or if you have topic recommendations, please, like I said, you can email me at info@thebankernextdoor.com. Make sure to follow me on Getter X and True Social. I will tell you, I spend the most of my time on X, but you can't follow me on those other sites. And remember that BND is on YouTube, Rumble, and all major podcast platforms. We post new episodes Monday through Friday, premiering at noon each day. And then BND Strategy Room is every Saturday night at 8 p.m. So that is that all my public service announcements there. So, okay, let's go to the story of the week here real quick. So last couple weeks, so I did Treasury yield 2 weeks ago. Last week I did yield curve, and then this week I'm going to do yield curve control. So yield curve control, also known as YCC, that involves targeting a longer-term interest rate by a central bank, then buying or selling as many bonds as necessary to hit that rate target. This approach is dramatically different from the Federal Reserve's typical way of managing the U.S. economic growth and inflation, which is by setting a key short-term interest rate, the federal funds rate. Advocates of yield curve control argue that as short-term interest rates approach zero, keeping longer-term rates down may become an increasingly more effective policy alternative for stimulating the economy. This approach could also help prevent a recession or lessen the impact of a downturn. So now I will say this about yield curve control. This was something in the Fed's toolbox that they had used a number of years back when the Fed basically was doing a lot of quantitative easing and they had zero interest rate policy. So this is not something, yield curve control is not something the Fed has really been doing very heavily here the last few years. But it's something that's in their toolbox, and they can break this out from time to time to help to massage or manipulate, if you, I don't want to say manipulate, massage interest rates. So yes, so just like I said, continuing on the yield curve topic there with our stories of the week. So, okay, now let's go to our quote of the week. So our quote of the week this week comes from The famous philosopher Seneca, and in his famous writings called Moral Letters, he wrote the following: show me someone who isn't a slave. One is a slave to lust, another to greed, another to power, and all are slaves to fear. I could name a former consul who is a slave to a little old woman, a millionaire who is a slave to the cleaning woman. No servitude is more abject than the self imposed. So I want everybody to give that one a little bit of deep thought. In other words, we are all a slave to something. What are you a slave to? And nothing is more abject than the self-imposed. In other words, these are things that we do to ourselves. So again, that was from Seneca in his writing on Moral Letters. So again, hopefully people find that one interesting. So all right, with that being said, that's all I got for everybody this week. I hope everybody has a fantastic weekend out there. Like I said, I'll be back again next week, with some more great news and great stuff to bring everybody. But until then, have a great weekend. Check out some of the other content on the channel. Check out some of my stuff. And oh my gosh, I almost forgot. This week coming up, I've been talking about the last few weeks about how I'm going to be doing some live stream specials on some very specific topics. So this week coming up, I will have my first live stream special. I'm going to be doing this on healthcare. So I'm hoping that people will find some of these specials very interesting. So this is going to be a healthcare special that I'm going to do. I'm thinking that I'm going to do it on Wednesday night, but I will put out up again. Follow me on YouTube. I will put out a post letting everybody know, and I'll also put up a notice. You'll get a notice too when I schedule the live stream too. So keep an eye out for that. That'll be coming up this week. So, but with that being said, I hope everybody has a great weekend out there. Make sure to check out some of the other content on the channel. I thank you so much for listening and hanging out with me on a Friday night. And everybody have a great time out there, and I will see you again real soon.